Good evening, everybody. Thank you very much for joining in. This is 11th in the series wherein we are going to discuss about the difference between fair value and intrinsic value. Today topic we are going to speak on the exact difference between fair value and intrinsic value as per accounting standards, and predominantly we are going to cover this topic as per US GAAP, which is FAS 157 and 133. Thank you very much for joining in. From this side, I am Rahul Magan, working as a corporate treasurer in EXL Services India, which is an Indian counterpart of a US Nasdaq listed firm. At the same time, I am a corporate trainer and a treasurer. I am a corporate trainer and business consultant in various forums across the world, predominantly in Asia, and also speaking for roughly 26 global forums. My first book, which is already published in New York, and second is scheduled to publish in Australia by December 2014. So today we're going to speak about the exact difference between fair value and intrinsic value. Fair value versus intrinsic value. What do you mean by fair value? Fair value refers to the value of any product, any services, any commodity as per the market. Example, take a very simple example, dollar. $1 is trading at 60. Now this is known as the fair value of a dollar. Now this fair value can be, it might be overvalued, it might be undervalued. Like we can say it might be overvalued or it might be undervalued. However, accounting standards across the world, predominantly US GAAP and IFRS, they are not in agreement of the fact. Take a very simple example. Today we're going to cover this fair value as per US GAAP, which is divided into US GAAP 157. 157 refers to the valuation of derivatives, or I would say principle of fair valuation. And US GAAP 133 refers to derivatives. But before to start with, I would like to elaborate I would like to take 2 minutes to explain the difference between fair value and intrinsic value. Well, fair value refers to the market value of a product. Now this market value could be overvalued, it could be undervalued. At the same time, intrinsic value refers to an ideal value of a particular commodity or a currency. In the today video, we are going to target about the respective currency. We are going to take our target would be currency, which is dollar to INR, where this is base currency and this is term currency or variable currency. Now FAS 157 or the valuation standard as per US GAAP is saying that any fair value can be divided into three parts, which is L1, L2 and L3. L1 refers to mark to market, L2 refers to mark to matrix, L3 refers to mark to model. What do you mean by L1? Take a very simple example, and we are going to in this video we are going to assume that you are talking about a company which is known as Infosys, who holds the hedge book of say $2 billion or say $8 billion. Infosys hold a hedge book of $8 billion, and predominantly we assume that out of $8 billion they are taking a forward cover of say 4 to 5 years. It means 0 to 1 year. Now let me write here in a complete way. We are assuming that Infosys is holding hedge book of 8 billion. We are assuming 0 to 1 years is say 2 billion. 1 to 2 years is say 2 billion, 2 to 5 years is say 2 billion, and 5 to 7 years is 2 billion. I'm again repeating the fact that we are assuming that we know that Infosys is an exporter, so in this, not to mention that they are going to sell dollars and buy INR. However, at the same time we are assuming that Infosys is taking hedges till 7 years, and this is the categorization. Hedges taken between 0 and 1 is 2 years, between 1 and 2, 2 years, 2 and 5, 2 years, and 5 and 7, another 2 years. assume the average hedge rate in this 62, 64, 66 and 68. It's all underlying assumption we are taking. In this we assume now time has come to do a mark to market. Time has come to revalue your hedge book. Now there are three options: L1, L2, L3. L1, as I earlier said, refers to mark to market. L2 refers to mark to matrix. L3 refers to mark to model. In L1, we are assumed that whatsoever value of prospective currency which is USD INR is available in the market, this is what Infosys is going to take. So assume Infosys is taking in this the 100% is market value. Now assume at that moment the market value would be 64, 66, 68, 70. Then they would be having a loss of plus 2 rupees into the dollar amount in their books, which they are going to pass in OCI. OCI stands for Other Comprehensive Income. In mark to matrix, there is no ratio defined. In mark to matrix means 50% of the data is what you are taking from a market, rest 50% of the data you are assuming. I am assuming 50% data is market and 50% data is yours. Yours means, I am again reiterating the fact that yours means the model which you build in. Third is mark to model. Mark to model refers to 100% data is yours. And this is as per FAS 157. Or if I speak from IFRS point of view, then this is IFRS 9 as well, which is valuation standard. I am again reiterating the fact that majority of the times, and please be note that these all are applicable for exporters as well as importer. Please be note that once you have a large hedge book, say $1 billion, $500 billion, or maybe a $1 billion, maybe 500 billion, 200 million, 300 million, majority of the times we have saw that corporate treasurers are calculating or they revalue their hedge using L1 mark to market, because most of the time big fours are supporting that. But please be note that the accounting standards, which is FAS 157, IFRS 9, they are supporting L2 and L3 as well. Now at the same time, I would like to stress on the fact that both L1 and L2 and L3, they are dependent upon a model. You need to make sure that the input parameter which you are taking in your model should be perfectly well, because if you are taking wrong input parameter in your model, it will lead to a wrong value. Take a very simple example. If your INR is like this, if your INR is depreciating, your model may end up with some positive value or positive M to M. However, if your INR like this, your model may act against you. So please be careful about the input and output variables of your model. At the same time, as a corporate treasurer, I would like to suggest the fact that you should take care of, you should regularly update your model as well. So I would like to reiterate the fact that fair value can be divided into three parts: L1, L2, L3. L1 refers to mark to market, L2 refers to mark to matrix, L3 refers to mark to model. Now there is no unique definition that it cannot be 50%, or you can have, if in L2 you have 100% yours and 0% market, then L2 is equals to L3, because in L3 you have 100% yours and 0% market. Now what do you mean by intrinsic value? Intrinsic value should be value of your commodity, your product, could be anything. Now intrinsic value can be further calculated into three parts. One is